Hey everyone, welcome to CoveredCall ETF Investing. I'm Jordan, and this is your central hub for deep CoveredCall ETF data. But in today's video, I thought it'd be fun to go back to grade school and actually grade some of these CoveredCall ETFs. It's going to be part of a mini series where today we will grade S&P 500 style CoveredCall ETFs, and in the next video we'll do a NASDAQ 100 CoveredCall ETFs. And these are all funds taken from the CoveredCall ETF ALLSTAR tracker, a Google sheet I created that I update every month to identify opportunities, red flags, and just kind of track all different kinds of CoveredCall ETFs across the spectrum here in Canada and the US. So that can be picked up on my Patreon. If you're curious about that, it'll be in the description below or on my homepage. So let's get started. This is a purity test. How much of these funds are actually like the S&P 500? And it'll be graded on 4 qualities. So the first one is how much of it is actually like the S&P 500, meaning sector mix. Does it own its underlying assets? Are the distributions frequent? Are they consistent? Do they pay out regularly? And what is the growth potential? I've heard from so many of you about growth potential with CoveredCall ETFs. That's always seems to be top of conversations when it comes to investing in these styles of products. So you just want to be able to know, can these funds grow naturally over time? And then you can simply, whether it's to live off the distributions or supplement other expenses in your life without worrying about the funds actually just driving down into oblivion. So that we're going to figure out with a video like this. So let us get going. I'll just kind of pick from randomly from in the middle, on the sides, and we will fill out this list. So for the very first one, let's just do XYLD. This is an American CoveredCall ETF by Global X. It scores a C mainly because its growth potential, not there. This is a pure income-driven CoveredCall ETF. No growth potential. It's 100% portfolio coverage at the money, which is just a fancy way of saying highly aggressive with CoveredCall premiums. Absolutely no growth whatsoever. By the way, I'll be grading growth potential based on less than 50% coverage. So with my own style of investing with these funds, I seek income first and foremost, but I lean growth. So typically things under 50%, or at least 50% and under. Distributions are all over the place with XYLD. So for those reasons, it can't score a B or an A, but its sector mix, S&P 500, its sector mix is very much like the S&P 500, and it owns its underlying. Let's do SMAX next. So SMAX is a B fund. Why? Well, the only reason that keeps it back from an A is the sector mix. It's not really, it's the S&P 500 adjacent. I would call it an equal weight S&P 500 CoveredCall ETF. There's about 20 funds in this CoveredCall ETF. Now, in my mind, I think it's to take advantage of certain parts of the S&P 500 that maybe have more growth potential. Also, speaking of growth, it has about 30% coverage on the fund. Its distributions are frequent. They're basically the same month over month, and it owns its underlying. So for that reason, SMAX gets a B. JEPI, let's go with JEPI. JEPI is a C fund. Why? Well, it owns its underlying. It's the constituency of those funds are fairly close to the S&P 500. It's about 100 plus funds or so, but its distributions are all over the place, and its growth potential is muted. Next up, let's do ESPX. This is an A fund. It's probably the only Canadian CoveredCall ETF out there that actually has S&P 500 right in the name. Its growth potential is there. It has about 33% coverage on the portfolio. Its sector mix is fairly close to the S&P 500. Now, in the overview paragraph that you'll see with ESPX, it invests in the constituents of the S&P 500. So that doesn't mean the S&P 500 verbatim. It still invests in those 500 companies, but they change the weightings around. So based on that, I could have been really picky and just been thrown it into the B, but it's fairly close enough that I would say that I'll give it the A. Its distributions are are stable, and it's been paying out consistently for well over a year and a bit now. It actually owns its underlying, so it checks all the boxes. So we'll give it an A for that reason. Let's go USCC. The only thing holding this fund back from being a little bit higher is its growth potential. This is an ETF that invests in basically a US large cap ETF, which is HULC. That's what it is. But HULC invests in pretty much the S&P 500. So for that reason, it gets a mark. Its distributions are stable, and it owns its underlying. So for that reason, it gets a B with 50% coverage. Doesn't quite make it up into the A category for growth reasons. Next up is ZWH. This is another by BMO, another Canadian fund. Distributions are stable. It has about 77 funds in it that are fairly close to the S&P 500. It owns its underlying, but again, 50% coverage holds it back in that regard. So for that reason, it holds a B. JEPY, probably one of two it's probably one of two funds on this list that aren't technically CoveredCall ETFs, but because it's part of it's on my tracker, I figured I'd put it on this list for educational purposes and the differences between funds that maybe we think are CoveredCall ETFs and funds that technically really are not. With JEPY, it doesn't own its underlying, so therefore its sector mix can't be that of the S&P 500. Basically what this fund does is it mimics the performance of the price of the index is what it does. Then its distributions are kind of all over the place, and with all those factors, growth potential based on S&P 500 CoveredCall ETFs just won't be there either. So if you are someone who's interested in JEPY, just know that it is not a CoveredCall ETF. Then again, just wanted to put it on the list just for that educational reason. Anyway, so let's go on to the other fund that isn't a CoveredCall ETF, but I'm going to allow it to score a little bit higher, which is iSpy by ProShares. Its distributions, albeit there's only been two, either way, the distributions are not consistent, and its growth potential yet to be undefined. Well, I should say it is undefined, but it owns the S&P 500, or it has the same companies of the S&P 500, so its sector mix is there. And it actually owns its own assets, right? Unlike JEPY, which does not own its own assets. Again, it just mimics the performance of the index through other various derivative strategies. So iSpy gets a little bit of a bump there, but everything else is CoveredCall ETF related. So let's go to USCL, which is just the leverage version of USCC. So USCL holds USCC, and then USCC holds HULC. But the reason I scored this a little bit higher than USCC is because of that leverage component. It has the ability to grow naturally with 25% leverage on the fund. So for that reason, it again holds all of its underlying assets. Its sector mix is pretty close. Its distribution output is stable, and growth potential is there, especially with the leverage. So next up, we'll do XYLG. This is the technical growth version of XYLD, but why do I rank them fairly similar? Well, they both have the same sector mix. They both own their underlying assets, but their distribution output is all over the place, and it's about 50% coverage. So yes, the other 50% gets to participate naturally in whatever the underlying assets do, but as far as the criteria, it was basically anything under 50%. We'll give it a mark for growth. But in this case, XYLG, it is the growth version of XYLD, but for the purpose of this video, I'm putting it in the C category. Next up, we got SPY. This fund has been quietly amassing quite the AUM in its short lifespan. No doubt a lot of institutional investors are piling into this. Over $1 billion in AUM, but I digress. Why do I give it a C? Well, its distributions are all over the place. Its growth potential, it can go up to about 100% portfolio coverage, and I think it's on the higher side of 50% just because it is consistently over 11% for its yield. So that tip will indicate for me that it will be over that 50% mark. But it owns its underlying assets, and its sector mix is fairly close to the S&P 500. So now to round out the video, well, I wouldn't say round out the video, but to round out the rankings, G-Picks, I give an A. Why is that? For an American covered call ETF, it has the rare feat of having a stable distribution. There are maybe a couple of covered call ETF funds on the American side that have stable distributions. I want to say maybe the other two are by Simplify with SVOL and Maxi, I want to say, are probably the most consistent, and this is like probably the second or third most consistent payouts that I've seen, which is from G-Picks. Its growth potential is there. Its portfolio coverage can range between 25 to 75%. So in a bull market, maybe they do less coverage just to allow for more growth of the fund. So I give it a point for that ability to do that. Its sector mix, fairly close to the S&P 500. I believe it's something over 100 plus funds. And it owns its own underlying assets. So now that everything has been graded, what do you all think? Where would you put some of these funds, right? Let me know in the comments whether you would rearrange this differently. So that is it for this video. Do the cliche thing and hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.